All right, good morning, everybody. I'm back on one of the old machines that got out of the off. It got out from being worked on, so I'm just taking a moment to check, make sure all the audios are working and everything is fine. Seems like we're good. I didn't have time to do any of the cutting and pasting, so we're just going to check it right from the email. 5 things you need to know comes from Bloomberg, and whether you have a Bloomberg account or not, you can go over to Bloomberg and you can ask for this email to be sent to you every morning. Normally, I just reference it. We don't actually look at it, but I kind of got tied up today, so I little behind. We can just look at the email, right? No big deal. So what we're looking at here is inflation day. They give a little shout out on that, kind of what they're looking for, what they think the numbers are going to be, and give a little bit of insight on it. They talk about Peloton this morning, FOMC positioning, and then the fact that we're up a little bit this morning, where we were at the time they sent out the email. So they're looking at around 8%, which is down from 8.5. CPI is one of the core bits of information that the Fed continues to reference. They like CPI. It seems like the rest of the market likes PPI. I say watch them both. Remember, the Fed has made it really clear they want to see definitive proof that things are moving in the right direction, right? So it's not going to be just one data point. It's going to be a trend of data points, each pointing lower and lower. Now, some really smart people have already pointed out that even though this round of inflation is abating, we're not done with inflation. Prices are sticky on housing, for an example, and wages are really sticky. So, we're not done by any stretch of the imagination. But the current round of inflation seems to be abating a bit, and the CPI, unless the numbers are way off, the CPI should reflect that today. I do believe, and so does a lot of other people, that at this point, good news is going to be bad news, and bad news is going to be good news, right? So, if we're trending in the right direction, that would be good for the market. Of course, we just got to let it come out and see. In these emails, they always have this little area down at the bottom, and it's not always Joe, but it's usually here's what somebody's interested in this morning, and it's a good read. It's usually a little narrative outside of the news that had already been covered, right? So if you're not getting these emails or hitting it on Twitter or something like that, you definitely should. The other one that you can point to is one called Morning Brew. Now, I'm a little new to this one. I haven't been using it for a long time, maybe a couple of months. It does have some advertising kind of tucked into it, so, once you get used to it, you can kind of just scroll through the junk, but there is some junk. It's usually a really good read, and maybe 3 times a week I get a nugget of information from that I wouldn't have gotten if I hadn't read it. And that's kind of my benchmark for something as simple as, do I want to keep getting this email every day? I get enough junk. I don't need to increase my junk load anymore. The Goldman Sachs layoff came out yesterday. That's not exactly new news, but they are mentioning it here. The nurses walking off the job. Still no word yet, as far as I know, on the transportation side, right? The rail worker strike. So if you're not getting Morning Brew and 5 things you need to know, maybe look into that. It's free, and it's just a nice little summary. Kind of get an idea of what's going on out there. All right, so here is finance juice. We can see that we've got some European Central Bank speakers today. We have CPI on deck. Not a whole lot in the later part. Not for us. Right, so there is that. Now, see, this is what kind of stuff you want to focus on. Although, I mean, I shouldn't be seeing CNBC in my feed. Thought I had cut that out. But if the market starts talking about another Fed pivot, then you're going to want to watch that market countdown tool. And see where the market thinks that pivot is going to end up. I'd say the market's going to be pricing that in still. So they're looking at a 25 basis point between November and December. But that's where you're going to want to go when you start hearing anything about pivot talks. The pivot would be pivoting away from their current stance of, say, 75 basis points or any kind of rate hike at all. Say that when is the Fed going to pause and let what they've already done do some work? That would be a part of a pivot. It's too soon, in my opinion, to be thinking about where the Fed is going to pivot. And if they are not pricing in 50 basis points at least, then they're going to. And of course, that's going to drive the market down. I don't have my watch lists installed yet, but we can get by. We don't need the watch lists. All right, considering what was on deck this morning, volumes aren't as bad as what I had anticipated. I thought they'd be a lot lower than this, somewhere around that 50 zone, and we're not. We're kind of in line. 96, 95, 114, 109. We're kind of right in that area. And that's all we need to see with this lower indicator. We're just checking to see, are the volumes within, acceptable ranges? They are. We're done with it. Before we go deeper, it's worth jumping over and taking a look at kind of the higher time frame. So we're looking at a year-to-date chart in the ES. We're coming up into that cyan line. That is an anchored VWAP. The anchor starts at the first of the year, January 3rd. The white line is a linear regression line. You can use the indicator to get that line, or you can just draw it by hand. If you click your mouse wheel, you get this regression line drawing tool. That's useful if you want to start the line at a different point. Otherwise, you can use the study, and it'll just capture however many candles you're looking at. Got to get the tool to lock. There it goes. Yay. All right, so swing high there, and that swing low here. Generally speaking, if you get a 3% move one way, you'll get a 3% the other, or 2% one way, 2% the other. That kind of logic. And the reason I point that out is after we got that high, we didn't come down and set a new swing low. We got blocked. We got shunted, right? Same thing that happened right there. Same thing back here where we got kind of stalled out, flipped back around. So there's a lot of traders that are looking for new entries. They want to go long. They want to go short. I keep arguing, don't diddle in the middle. We had our pivot high. We have a higher low. And we flipped there. Until you break this high up here and you set a new high, you're not safe to go long. I mean, you can take some short duration stuff. Yeah, we're talking, you're in and out in a day, maybe 2 days. But if you're looking to try to swing Apple or swing Google or, run Tesla back up, you have to get the S&P back above that level. If you don't, and you try to long everything, and we get tangled up against these pivot points and just dump right back down again, it's because we hadn't yet set that higher high. Conversely, to the same thing to the downside. So the markets don't like lower highs and lower lows if we're looking for, a retest. So in this move down, when it tried to come back up, when it failed to get back up, that was the next leg. And then when it tried to run up, it failed to do the same thing. It was the next leg. So right now, when we sold off and we tried to run back up and it failed, the market just dumped it like a brick in water. So right now, we have to get this pivot point at the very least above that area there. And better still would be up here. And anything less than that is just a very short duration trade. One of the reasons that I came out to the daily to start out with is this green line. That is the weekly expected move. We are there right now, right this moment. So for the entire week, we were expected to travel somewhere between this green line and this red line. That is the measurement for the expected move of the week, right? But that was for an entire week, and we got there already. Between Monday and then the Globex overnight, we already got that range done. The market's really inefficient right now. Normally we would say the market's a very, very efficient market. And normally it is. It's really efficient. And normally these expected moves are very accurate. But when they're wrong, they tend to be wrong multiple times in a row before they start to clean things up. The range for this week's expected move was really narrow, which didn't make much sense because we've got a lot on deck, a lot of volatility expected to be seen in the market. So keep in mind, if we break outside of these ranges, what's going to happen to the market? The algos will buy into buying. So if we break to the upside, the market makers are going to have to hedge, right? Because they got to get back to delta neutral. So if we break out and we start running to the upside, they're going to buy into that buying to get back to delta neutral. They're trading S&P options to build their position. And then they trade the S&P futures to adjust that position back to a zero delta. Futures have a hard delta, so trading those makes sense if you're trying to adjust your deltas. A little bit outside the box isn't bad, but if we get like an entire 2 sigma move outside the box, things can start to get really bad. The good thing is their positions that we're talking about will end at the end of the week. So it's not like this continuing, punishing, brutal sell-off. Now, when we say they and them and market makers, there's a lot of different styles of funds out there, a lot of different institutional trading systems. Talking about one group doesn't mean you're referencing all groups. This Friday expiration discussion that we're having is one group, one kind of firm and institution. And they're building strangles or straddles along these lines, and then they trade those futures against it. If you want to read more about that kind of stuff, when you're on Bloomberg or maybe the Wall Street Journal, type in dealer gamma hedges. Really type in that one and read some of the articles that pop up. They will talk more about this selling into selling or buying into buying, and they'll talk more about that dealer gamma positioning that I'm referencing here. The main thing is we're at the line. So if we continue to break above this, a little ways isn't bad, right? Like back here when we broke down below the red line, it was just a little ways outside the red line, not a big deal. But if it starts to get too far away from the red line, it will become extreme. It'll pick up speed, or the green line in the other direction. All right, like we do every day, just take a quick glance at the market watch. Even though we were looking at finance juice already, there's a lot of econ that comes out. And one place isn't likely to give you all of it. So make sure you check in a couple of places. You can even use the Discord bot and ask for the econ of the day. Right? You don't necessarily have to go out to a web page to get it. So we got CPI, and then we have additional auctions today. Those additional auctions are game-changing events. I don't know why they're not covered more. It seems like I'm the only one that ever talks about them. But whenever I see these, I mark them down, I watch the clock, and I look for a reaction out of the market. We got one at 11, and we have another one at 1 o'clock. Pay particular attention to the time of day today when we get around those two time zones. Especially when it's one of the key ones. So the 2, the 10, the 30, those are three very key auctions that you want to pay attention to. And just more recently in my own life, I've started paying attention to that 3-month. I didn't used to. The IRX, I'm paying attention to that one more now. So when you see the 3-month in there, keep your eye on that one too. Now we come over and look at the ES. There's 3 things this market could do on a day-to-day basis. One would be that we stay inside the range. The other would be that we break outside of yesterday's high or we break outside of yesterday's low. Well, we're already out, right? We've already left the range. We did that last night. So now the argument is, okay, well, where are we going to go from here? Are we going to come back inside the box? We're going to continue to expand farther away from the box. Depending on the CPI, no amount of technical analysis in the world would give us an answer, right? We could measure candles, we could talk expected move, but until the numbers come out and we see what the CPI is and how the market responds to it, no other technical analysis would matter. But what we want to think about is, okay, it's going to be market moving. I think everybody's agreed to that. Good, bad, market likes it or doesn't like it. At the end of the day, I think we've all agreed that when these numbers come out, we're going to see a significant move in the market. That's what we want to analyze. So what would a significant move in the market look like? The ADR right now, 1.73%. Half of that ADR would be 4,100. The full ADR would be 4065, and that's a downside move. Half the ADR moving up, 4174 and 4209, really close to 4211. So if things go really good today and we begin to expand to the upside, 4209, that is well within our boundaries. That's a normal move. If things are going to be drastic today and they're going to be more than normal, you're going to want to measure farther than 4209. Generally what I do to get that measurement, I just keep things simple, right? Measure the distance between those two. And then just take that line and set it up there. Now you could do the math, you could look at the percentages and cut it in half and then add it to the right. Yeah, you could do all that. You could do all of that. Or you could just draw a line. $42.45. That would just begin to put us into an extreme. Now we're already up, more than 0.5%. And 1.7% is the move of the day. This that I just added would be a full move from the Globex open all the way up of more than 2.5%. That feels about right. If you were to go back and look at how many times the S&P has made a bigger move than 2%, I mean, sure, it's happened quite a bit, but less than 3. A 3% move doesn't happen very often in the market. Usually it's connected to very extreme, very drastic events in history. So while we can move a 3% today, unless the numbers are really out of jack, I don't expect that. Now, to the downside, we would want to do the same thing. If the ADR is 40.65 and the distance between this red line and that yellow line is the same, we can just come up here and steal that line. That puts us at 40.31, which is a cog line. To get there, we would have to cross through the daily pivot, but we would still be above the weekly pivot. And as long as we're above that weekly pivot overall, generally speaking, in the market, we're going to maintain that risk on or bullish stance rather than a bearish stance. Still has to be predicated on everything else, though, right? The VIX, the dollar, what's going on in energy. We can't just look at the S&P and say, well, we're above the weekly pivot, so we're bullish. Nah, that's not enough. All right, now, what we haven't hit yet are moving averages. And I continue to point this out, that you want to take an opportunity when you're on the higher time frame to check your major moving averages. Are we going to hit one today? Did we hit one yesterday? Are we moving towards one, or are we moving away from one? Check the daily, check the weekly. Now, I mentioned yesterday that 200, right? I mentioned it was in play. It's still in play. Now, to me, I've got two 200s, the EMA and the SMA. I got them both. The last time we deflected, it was on the 200 SMA. We went through the EMA after tagging it, pulling back, and then breaking through it. So we have been interacting with this one, but we also interacted with that one. Want to keep them both on the table. We are starting to get a little bit away from that 10-period moving average. And like I've mentioned before, keep track of how far away from the moving averages we get, because it often becomes the mean, right? It's where we, it's like the center of the basketball court. Everything starts from the middle. So year to date, our major reversal area seems to be about 3 1/4, and we're at 2 1/4. So we've got some room before it's considered, I hate the phrase, but I'll say it anyways, overbought. We're not overbought, but we're nearing that area of what would be considered overbought. We would expect the market to pause, to consolidate, to turn around and go back the other direction. And if we get a big move to the upside today, we're very likely going to break that barrier, that 3 1/4% away from the 10 period to the upside. Obviously, if it's bad news, we're going to go back and find that 10 period moving average. All of the moving averages can be plotted on your intraday chart, by the way. Thinkorswim has indicators. Just type in the word daily, and you'll see daily SMA. It doesn't have to be daily. You can do a 2-hour, a weekly, whatever you want. So it would take this daily moving average and it would plot it on your intraday chart, like your 5-minute chart or whatever you happen to be looking at. So here's the weekly. Orange line, that's a 50. It's not dotted or dashed, so it's a 50 EMA. And we're likely to come into contact with that. It's around 41.70. If we continue this upside move, we're likely to hit that today. Very often, a moving average from one time frame will be a different moving average on another time frame. For an example, the 10-period weekly often is a 50-period daily. Not perfect penny to penny, but generally speaking, when I see a 50-period daily moving average, I think of it as a 10-period weekly until proven otherwise. Either way, we got that 50 overhead. We got the 200 overhead. We're likely to make contact with those if we continue this upside push. Now, even though I'm on a weekly, that's really yesterday and last night combined, right? That's all we've had this week. If we were to move to the downside, we would want to target closing the gap. So first, the high of last week, and then the close of last week. The close of last week is very likely going to be a considerable pivot point. And it would be the gap fill, because right now we're gapped up on this weekly. So if we start moving to the downside, that's what we're going to focus on. It would have been nice if I had my charts put back. Yay! All right, 10-day, 30-minute TPO is on the right in blue. Volume profile is on the left in green. As you can see, we've greatly expanded beyond the box. We're well outside the boundaries of the weekly expected move. The previous week's high that I had already mentioned at 40.77. If we were to break to the downside, we have a little bit of volume around 41.30. Then it gets really shallow, and it doesn't start to pick up until we're underneath the previous week's high. And that's important to recognize because price generally moves through these shallow areas quickly, right? So you're absolutely going to want to recognize if we break below that 41.27, 41.25 area, it's going to be kind of like a free fall, and that the pivots that we could recognize don't seem to have a lot of volume around them. Then we start picking back up into the volume nodes around 40.50, and then we're back to the top of the value area high box, the point of control value area. All of those are far enough away that we're not likely to get all the way back to the point of control today unless things are just really, really bad. All right, for things that are bad, there is an untouched point of control at the 618 June retrace level, 40.65. It's not perfectly lined up with that point of control, but close enough that I don't want to draw a VPOC line. Also, yesterday's point of control, we could argue we haven't hit that yet. It's also an untouched point of control at 41.26. Call it 41.27 since we ticks. So 41.27 untouched point of control there as well. We can look overhead. I don't think we got. Yeah, we do. Imagine that. $41.89, $41.95, and then cog lines CPI high 42.13 and 2 ticks. So we got some levels overhead worth kind of catching as well. All right, we're still getting that sell-off in the dollar. We are broke below yesterday's low. We had started to stabilize yesterday and kind of came back up, 50% retrace of that liquidation. Then it seemed to stall there on the previous day's low. It couldn't get back inside the box. And then we had that sell-off again. Want to keep your eye on the dollar. This is directly impacting everything, right? That pullback in U.S. China and U.S. Japan, the rally in the euro. Now, Bank of Japan had come out and said 145. That was it. They weren't going to let the market get above that, and it stopped, right? People smarter than me pointed out that it just goes to show that policy sets price, right? Makes perfect sense. So a lot of times when you're trying to trade anything, seeing what's going on, reading the news, that it's not just the candles, I guess is what I'm trying to say. It's not just the candles. You got to be able to check what's going on in the news, and not like CNBC kind of junk, but policy statements and official news. The breakout in oil didn't stick. The VIX is still sleepy, really not doing much of anything. And that should be a little bit of a surprise. We've had a significant move off of that VWAP. And the VIX still sleeping. In fact, it's still moving up. It was doing that yesterday yesterday wasn't overly bullish by any means, but the VIX was continuing to move upward anyways. So it's like we've been saying all year. The VIX is kind of out of whack. It's doing its own thing. It's not going to be a great proxy like it normally would be, but it's not completely useless. We just have to kind of approach it a little bit differently and tie it into the other parts and pieces. What's going on in stocks, what's going on in bonds, the dollar, the oil. Even Bitcoin managed to break outside of yesterday's range. But right now, it's all going to come down to the CPI numbers and then follow that, right, with what if. Any pattern that you've seen or setup that you have in anything with a high beta equivalent, something that matches the market, is going to do whatever the market's going to do today. So if you're thinking Apple or Microsoft or Google, whatever, if the chart is saying long, but the CPI is bad, the chart's going to be the last thing you want to look at. Dow Chemical is down more than 1% this morning. Oracle is up more than 1.75%. Bank of New York Mellon is up nearly 1.5%. PayPal, Nvidia, another bank, Bank of America, Chevron. So it's kind of a mixed bag. We got a significant amount of energy names up there. Now, consumer discretionary, information technology, and finance, those are our risk-on markets. And that's what's populating the top of the list. If we were in a capital rotation, say going back to energy, then energy would be dominating this list. Utilities, consumer staples, real estate, and that's not what we're seeing, right? I mean, sure, there's a little bit of energy in there, but it's been that way all year, that there's been some form of energy, whether it's solar, nuclear, oil and gas. There's been some form of energy all year. So it's not a surprise to see some energy names in there, but dominantly what we're seeing is tech and finance and consumer discretionary. And that's what we would expect to see in a positive market this morning. So remember, head and shoulders, moving average pairings, everything is going to be set aside and focused on what are the numbers going to give us. And measure your extremes. There's a market maker move on the SPX this morning, but there's not a market maker move on the ES. Very likely that's because the SPX has not updated yet. All right, so the market maker move was likely on there yesterday. I can't say that it was because I don't remember, but it very likely was there yesterday. What you want to be looking for is, does a market maker move show up on the S&P and the NASDAQ after CPI? If so, then you want to add that to the distance that we measured out. Right, when we're talking about, that line up there that I drew, you would want to also add half of the market maker move to that. We got a failed flag play on NVIDIA. Target would be to get the gap closed at the 150. But again, it's just, if we're bullish today, have bullish levels lined out, right? Like if the CPI is good, NVIDIA is going to go up. But so is Apple, so is Microsoft, so is Amazon. You know what I mean? Like across the board. Meta is going to go up. All your FANG names are going to go up. A lot of your financials are going to go up. Start weeding through the list and saying, okay, if finance goes up, what finance name do I want to trade? How far is it going to go? Throw your ADR on there, measure your ADR levels, and think about how far we could go for the next 2 weeks, right? Because the Fed is still on deck, but we can get through the end of this week at the very least. So Friday expiration options, but you could also be targeting next Friday's options and then just get out before, you don't have to hold them all the way to expiration. So kind of put together two levels, bullish to the end of the week and bullish till the end of next week. Use the expected move in here to see how far you could go between this Friday, which is $7, and next Friday, which is $11.50. All right, so say I wanted to go long NVIDIA. This says we can travel $11, not even adding the market maker move, right? Give myself a little bit of a buffer. Instead of trading the 146 options, I could trade 146 plus 11 or minus 11 if you want to use puts and trade those options instead. They're going to be cheaper. Yes, they're going to be, pretty far out of the money stuff. Ah, they're going to be pretty far out of the money stuff, but it'll be the distinction between do you want to be do you want to trade a cheaper position that has the potential for much greater reward, or do you want to trade a more expensive position that has less max reward? Right, and it's no different than, say, a lottery ticket. A gas station lottery ticket is a really, really cheap thing. You can go in, $2 and buy yourself a lottery ticket, but your chances of winning that lottery ticket is really, really low. Low risk, low probability trade, or greater risk, greater probability trade. Whichever one you want to, fits your goals. All right, so Bank of New York Mellon is already gapped up from this red. That's a red to green and a gap close in a little bit of a cup, right? If you look at the bid ask up here, we're seeing basically 45 and 46. Well, there's 45, and then 46 is way up here. So price is kind of somewhere in the middle of that. Either way, it's a fully formed red to green. And if we're going to be looking at a rejection in financials, that would be a good one, just because of how far up it's gone. It's up nearly 1.5% this morning. But if we turn bullish in financials, or if we turn bullish in the marketplace, this, having already gapped up above 45.5, might have a really nice support level to find some help on before continuing that rally to the upside. Right, Ford's another one with a red to green. And just full disclosure, I'm already in Ford. I'm building position here. Sold a couple puts, so I don't have stock yet. But, when I'm talking about a symbol that I'm holding, I always like to let you guys know, hey, I'm in this. I don't think it changes my opinion of the stock, but it's still the fair thing to do. So we're red to green here. Ford is gapped up this morning, 1567. So it's up 10 cents, maybe a little more, 13 cents. What I want to be watching for here is that it's going to be able to gap up at least as high as Friday, but preferably higher than Monday. That way, at the open, if we start to fade back, the high of Monday will be a support level. If we do continue to make that move, then 16.25, maybe 16.5 would be a good target. Same thing for a downside. If we just get numbers the market doesn't like and we start to dump, then 15 would be the first target and 14.75 would be my second target. I wanted to mention something on Apple, by the way. I seen some people yesterday taking Apple short near the end of the day. And when I asked them why they were going short, they said, well, look how far it moved. I mean, that was their entire answer. Look how far it moved. Yeah, I get it. It moved a long way. that's not necessarily a good enough reason to go short, especially when it comes to Apple and economic events. This back here, that was an FOMC, and then that just absolutely amazing response on the other side of it. There is a trade strategy called the aggressive contrarian trade setup. Tasty Trades, if you go to Google or YouTube and you search for that title, you'll find a lot of their videos. They went around the United States talking about it. So going opposite the direction makes perfect sense. After it sets up, just taking it on faith at the end of the day after a big green candle, that's not necessarily a fully formed strategy. That's just, well, I felt like it went a long ways and now it's going to go the other direction. Now, I got to give them credit. Getting in before the end of the day is a good way to go if you're willing to take the risk, right? Because shorting it near the end of the day rather than shorting it this morning, because it's liable to fall a good 1 or 2% if we get bad news, and then trying to short it would kind of make sense. But trying to short this in front of an economic event solely based on the idea that, well, it moved a long ways in one day, so I'm going to try to short it and go to the other direction the next day. Not necessarily a good play by itself. If you put some metrics into it like Tasty did, they've got things like, well, in the last 5 days or in the last 7 days, if it moved more than 10%. And I'm throwing numbers out there, but I don't think that my numbers are accurate. You definitely want to watch the video. But they did have more to it than just a one-day move, right? Like this moved 7.5% in the last 3 days. All right. That kind of fits. Red to green on City. And we'll be coming into a TRB soon, trendline breakover. So this morning we're already up to 51.27. So we're above, just barely. We are right at yesterday's open. We want to see City get above that line. And that way, as we come into the open and it starts to pull back, we'll be looking for it to find some support at the previous day's open. Then we get that push to the upside. We look for an inside day breakout, and then we target the next level of the cup, right? Because we are still focused on a cup, whether or not we get a handle. Red to green in Home Depot too. This one's up to $300, closed at $297.50. So it's most of the way up this body, right around this area. We want it above that open from the previous day. And that should get us completely outside of this range that it's been struggling with, right? Maybe this time it'll stick. Maybe. All right, so it's worth mentioning this. See if I can find an example of it. Yeah, kind of. So when the ES in the Globex comes up and sets a Globex high and then pulls back off of that Globex high, what you'd want to see is we open somewhere around in this area. And then you're looking for that first push up to that Globex high. We get through that, then you want to focus on the high of the previous day. And you're looking for this reversal. Now remember, it's all going to be predicated on the numbers anyways. But if the numbers are good and we can set a pivot before we come into the open, then that pivot's going to be what you're going to want to focus on. We're already completely outside of yesterday's trading range, so this primes us up for one of my 4 trend days. If we break this Globex high in the open, and the news is from the CPI is good, then expect a trend day today. I don't think you're necessarily going to get your alpha protocols, but you should very easily get a trend day. A trend day should run all the way to lunch. So we're not going to be looking for reversals. We're going to be looking for continuations, right? Micro flags, 786 pullbacks, 1, 2, 3s for the next target, ride the 9 strategies, anything like that. You can validate those and get the confirming flow push, checking volume accumulation, advanced decline, C-tick and tick, weighted AD, trend quality. All of those should line up and provide that same kind of validation, right? If we're bullish, you're going to want to see that green line lead the pack. And if we're bearish, and lead the pack upward. And if we're bearish, it should lead the pack downward. We don't want to see the green line inside these 2 lines, inside the channel. At least not until the later part of the day. And that would be that it be more of an indication of the broader market all participating in it, instead of being run by the top 3 sectors. All right, we got about 10 minutes before econ really starts to rock everybody out. Be careful, be safe, have a good day. I'll see y'all tomorrow.